Hey guys, back here making another video. I know it's been a while, but just wanted to talk about today's price action and review the model that I usually trade off of. Usually it's pretty simple and mechanical, but also, taking into other considerations about price action, discount and premium, about where I would usually want to see the model play out. But let's go ahead and start here. I just brought up the 1 hour just to kind of show here, where price turned, and then we can deep dive and check that out. And also you'll see the model playing out in these specific areas. We're gonna start off with high time frame and then work our way down, and you'll just start to notice you know, when it plays out and how well it does. But anyway, let's jump into this here. So I really want to bring your attention down here once we start going down to the 1 minute and sub 1 minute. But let me start with the 1 hour, 30 minutes. I didn't really see anything that where the model played out, and I will describe it here in a little bit. And I have in my previous videos, but every video I make, I'm going to go ahead and describe it once I see it. So I don't see it here. Let's talk about, let's look at the 15. I don't see it playing out. Okay. 5 minute. All right. So I don't usually trade the Asian session, but here we can see it playing out in two areas, in several, actually a couple areas, and just kind of wanted to bring your eye to it. So usually I like to see, so this is the opening. It's what, 6 o'clock, 4 o'clock. Actually, the opening is right here. All right, so it moves up, and right here is the very first sign where the model takes place. However, it really wasn't qualifying for me. I would have not qualified this as an entry once I saw the model. So basically what I'm looking for is if we're going to be bearish, you want to see 3 bullish up close candles followed by either one or multiple, in this case 2, bearish candles. And so long as they're consecutive or just one, you really want it to close underneath the very first bullish candle that started that run up. At this point, it would be considered a market structure shift. That's how I qualify it. However, I wouldn't have trusted this one simply because what I would like to see once this closes underneath, I want to see a fair value gap left behind, and I don't actually see one here on the 5 minute. That doesn't mean it's not in a 4 minute, 3 or 2, but as far as the 5 minute goes, this is a good sign, but there's no fair value gap to go short inside of. But what I do like about this is that we took out Monday's high, and usually you want to see, a purge in liquidity like here, right? So we got 3 bullish candles going up. We purged and violated Monday's high, and then immediately displaced down. So that's what I would like to see. You always want to see some form of liquidity being taken out of the market. Like an old high, old low, relative equal highs, relative equal lows, and we'll take a look at that here in a little while. And so that's what you want to see, and then you want to see this specific formation occur. You have to have at least a minimum of 3. Minimum. It can be 3, it could be 4 or 5, but you just need it to be consecutive, and you need consecutive or 1 to the downside if we're bearish. And you have to have a fair value gap, but in this case there's nothing here. it does displace lower. And again, we just sit here and wait, you know, and as you can see, it does come back into it right here, right? Almost takes out this high here, but what's interesting about this is that when it came up here, I mean, it obviously rejected off this little area, right? But what I found interesting was that it left, it didn't take out that high, and in the process, it left relative equal highs, right? So we'll extend that across for the day. So anyway, we're looking for the same specific formation, but to the downside because we're already in premium. Okay, we're already coming from a really high area. Just recently took out Monday's high. We have the formation occur, no fair value gap, so we got to wait. So as we're still looking here, we see there's two, nope. We see one down here, it doesn't quite, and we see the three, and then one, two, three, but it does not quite close underneath the opening gap, or I'm sorry, the opening price of this bullish candle, so that does not count. So we can't go short there. Um, we do see here, let's see, right here. So this would have definitely tricked people. And so here you see, here's a bullish run, right? So we see three down, and then one, two, closing above that swing high. We do leave a fair value gap behind. However, see that there, but I'm not necessarily interested in going long. And why do I say that? I say that because we're still pretty close to the most recent high. So I wouldn't want to be long. Doesn't make sense. But so we have at least a fair value gap behind, and it also leaves an inverse fair value gap behind right here as well. So ideally, like I wouldn't have gone long here just because of where we're at. But if you were to take this, this does meet the criteria to go bullish. However, as you can see, it ultimately comes back down. And, if you were going to enter here, your stop loss is down here. It does temporarily work in your favor, but ultimately takes you out, right? But hopefully by then you've already moved your stop loss to at least a break even. But anyway, but we're not looking for shorts or we're not looking for longs. So we wait, and right here, we didn't quite take it out. We displaced again. So we see another, I mean, I don't really have a name for this other than Laserland called it the BigO model. If you guys have a better version of calling this, then, let me know. But as of right now, it's just called the BigO model because I don't really have a name for it. And it is derived from, it's basically a modified version of the 2022 ICT mentorship model. Yeah, but this one's very specific. So again, here we are. We have 1, 2, 3 bullish candles. We don't quite take out the liquidity, but what's interesting to me is that we left relative equal highs and then we displaced really quick. So even though it didn't take out liquidity, I would still reference this as taking out the liquidity from the high. And then also the fact that we didn't quite take that. We also left relative equal highs on the 5-minute, and we have our model here. We got 3 up close candles, 1, 2 down close candles. So there you go. We have a regular bearish fair value gap. So we got a 5-minute, and then let's see. So there's the fair value gap. We also have 2 small inverse fair value gaps from here to there, and then from here to there, but they're not as significant. You really want to use the more obvious big fair value gap to as your entry. So conservative, you want to go at 50%. Stop loss should be at the high or right here at this high, just outside of the fair value gap if you don't want to hold that high. But your best fair value gaps should not even get near the top. So it's up to you where you want to put your stop loss. You put it here, put it there. But there are going to be times where sometimes it will reach, take that out, and then just plummet. So you got to take that into consideration. Anyhow, so we have the model here. Fair value gap, price goes into it, and then basically just falls apart. And if you were entering on the 5 minute, well, I always tell people, exit at the nearest swing high or nearest obvious swing high. So if you were to enter here, your exit should be down there. So about 70 and a half handles. And if you can hold longer, then either aim for the most obvious swing low, and then the next obvious one, if you can hold that long, and then here, down here, you also have relative equal lows, right? You can use these relative equal lows or these as a target, right? So it always tends to do that, it tends to attack relative equal lows. So keep that in mind. So as you can see, take it out. So that would have been a really good run, assuming you held that long. It's about 143 and a half handles. And then, so, now we're down here. We're in down discount compared relative to where we were from the previous day's range, right? So let me just shrink this a little bit. So if I were to grab the previous day range from Monday's high to, Monday's low, 50% of the range is right there. So right here. Okay. So it worked up here, and now the BigO model occurred once again right here. And this is actually where I took a trade and it failed for me. So we're here, we have 1, 2, 3, 4, right? And then 1, 2, 3, we close underneath. We do have a fair value gap here, but I don't necessarily like these because what I want is a fair value gap to be inside of these bullish candles. So ideally we would want like to be in here or something. But the fact that we have a fair value gap that we have, half of it, roughly half inside the bullish candles and then the other half outside. I don't really necessarily like that. But if you were going to take a short, if you saw this and you were willing to take a short, I would enter in the upper portion of this fair value gap. So basically anything from the opening range here to this fair value gap, and your stop loss should be like no higher than that to minimize your exposure. So that's about 101 ticks. You don't really want to go way up here. Or, if you're not willing to enter there, you do have these smaller inverse fair value gaps. You got one here, two, and then three. So these are all small, and depending on which one you enter on, you want to, like, so if you entered on this one, your stop loss should be here or at this high. And if you entered on this smaller one, then your stop loss should be right there. That makes sense? And obviously, as you can see, it blew right through it. And so when that does occur, when I see this and it blows right through and we close, any candle closes above the swing high, then I start to use it as a inverse fair value gap or inverse BigO model. So here it was bearish, right? Had a bearish profile. And now that we closed above it, then I'm anticipating using it to go long as an inverse. So using the same criteria, you want to still use a fair value gap inside these bullish candles that are, I guess, now considered an order block, right? So if you extend that portion out to the right, after we've already closed, right? Once this candle closes above it, now I start looking at this as an inverse to go long. And as you can see, if I extend that fair value gap, this upper portion of it, right? It's really this, right? But you really just want to use the upper portion, like I said. So price comes back into it, 1, 2, 3 times, and then finally it's off to the races. And that's on the 5-minute. And then after that, I mean, you never really saw the model play out anymore on the 5-minute at all. Yep. So that's it. It occurred 3 times. First one was right here during 10:35 p.m. However, again, it didn't quite meet the criteria 100% just because it didn't have a fair value gap. But as you can see, it did hit this 5-minute order block, newly confirmed order block, left relative equal highs. So we know at some point it's going to come back and take this out, right? Let me delete that here. And then it occurred right here at 355, fair value gap, go short, exit, swing low, relative equal lows down here. And then that 1 hour fair value gap that occurred, that we were looking at earlier on the 1 hour. So this is the 5-minute. So if you're just playing on the 5-minute, that's what you would be looking for. And I hope that helps. So now let's go down to the 1 minute. Actually, let's go down to 4. Let's see if it played out on the 4-minute. All right, so let's start right here. So we took out the high, but 4-minute does not look clear. See here. Interestingly enough, so this 4-minute right here on the 4-minute is pretty clear. Got a couple fair value gaps. You don't really want to enter on the lower one. You enter right here if you were to go short and exit at the nearest swing low. And yes, it does, but if you're going to try to hold longer, ultimately it comes back against you, stopping you out. But you sit here and wait because we're still in premium. We were looking for shorts, not longs. And yes, there's a long there, but doesn't quite, it does work here, but your fair value gap inverse is up here, a little small one right there, but ultimately it fails, right? So here in the 4-minute, it's also very clear. We're coming from premium. Displace, we got 1, 2, 3, 4, displace, fair value gap. There it is. And then, let's see, let's keep watching. So here's the 4-minute, but on the 5-minute, it's kind of the same thing a little bit. 4-minute. And as you can see, occurred here, it failed. It's not as clear for, well, I guess this would be your fair value gap, right? On the 4-minute. And your stop loss, by the way, would be this lower wick here, if you were doing it on the 5-minute. So look for 4-minute. So here we do see a bullish 4-minute entry. However, again, I wouldn't want to go long from up here. So it occurred here, 1, 2, 3. We closed above. We have fair value gap behind. Price goes back into it. It starts gyrating a little bit, and you can see. I mean, these are 4-minute candles. So 4, 8, 12, 16, 20 minutes, like almost like 30 minutes, and this still sitting here. Like it should have only 1, maybe 2 candles and then push away. So if you were in this trade, and you had your stop loss up here, I mean, all this time right here, you should have already started moving your stop loss up here to break or near break even to get out. But at the same time, even though this had occurred here, I mean, you don't want to go long right here because we are in premium relative to where we were this morning. This morning we were down here, right? And this occurred up here. I'll show you, here it is again. I missed this one. So this is discount, Again, we're down here, close above. We are still a little high, but still 50% of the range from that nearest high to the nearest swing low. So this one leaves your 4-minute fair value gap behind. Doesn't quite take your low. Pushes off and ultimately comes back against you. And if you would add your stop loss right there, you would have been taken out, right? But it would have worked temporarily. That would not, ideally, that's still, you're still at the 50% level from these relative equal highs to that low. But up here, now you're already in premium. So you really wouldn't want to take that. So there's the 4-minute. And I don't see anything else down here. Nothing here. Let's look at the 3-minute. See if it yielded anything. So here's the high. I don't see market structure shift on the 3-minute. We do have one right here. However, there's no there's a fair value gap right here. Yes, it does hold price. So if you were to go short there, it would have worked temporarily in your favor. You could have entered here and then exit this here swing low before ultimately coming back and stopping you out if you hadn't taken anything out. So that's the 3-minute. At least right there on the 3-minute. We were looking at this on the 4-minute and actually it was clean, but the 3-minute there's not, because we have that interruption of a bullish 3-minute candle here. So I wouldn't have, if you're just looking at the 3-minute, we wouldn't go short there because of that. So we would continue here. There's the model here, however, no fair value gap. There is a tiny little inverse. If you were going to go long, it would be in here Stop loss should be down here. It does kind of work in your favor ultimately, right up here, but ultimately will take you out if you didn't take something out of the market. So here's the 3 minute. So it's very interesting that on the 5 minute, 3 minute, 4 minute, this same area is showing the same exact formation. A little bit different variations, right? I think the 5 minute was 3 minutes or three candles, and then same with the four. Now 3 minutes, 1, 2, 3, 4, 5. And 1, 2, 3. Closing underneath, we have a fair value gap, the same, almost the same fair value gap as the 5 minute. We wait for price to come back into it, enter at 50%, and then go short. And obviously this ended up working, right? So then if you continue to look for shorts on the 3 minute, it did not occur here. On the 4 and 5 it did work, or it appeared, but on the 3 minute it was not clear. So continue looking for the model. So right here it did occur. We got 4 down close, and then 1, 2, 3, 4. We closed above. We got 2 fair value gaps here inside these bodies, so you could use this one or this one. You want to use 50% always. And again, this was the same formation on the 4 minute. It did work out temporarily before ultimately coming back against you. So there you go. Could have yielded something, but either a break even or won something. Again, so here we're looking at 3 minutes, and then after that, nothing ever appeared. So let's check out the 2 minute. All right. Here we are, Monday's high. Took it out. We don't see the formation occurring on the 2 minute. Let's just hit up these main areas. So here it actually did. So we have 1, 2, 3, 1, 2, 3. Third candle closed underneath. We do have one fair value gap, and then this portion up here. However, if you were just going to trade on the 2 minute, I mean, obviously it didn't reach it, so you were kind of SOL on that. Let's see here. So we're looking for shorts. All right, 2 minute. Right here it occurred. You got 1, 2, 3, 4. 1, 2, 3. We left the fair value gap behind, but again, it never came back, so you were kind of SOL on that. All right. And then here we have 1, 2, 3, close underneath, fair value gap behind. However, no price ever came back into it. But we do have the inverse fair value gap right here. So you could have taken that, right? Inverse. I mean, we closed here, we have inverse, inverse, and then one regular fair value gap, which it never reached. But those would have been one of your 2 options as an entry. All right, it plummets, goes back down, and then right here, we have a 2 minute. However, there's no inverse and no fair value gap. So even though it closed above, this would not have given us an entry, or at least an opportunity to enter. All right. Look here. All right, here we do have a 2 minute. Right. We have a fair value gap right there. Just barely pokes its head in there. And then we also have the inverse right there. If you were going to take an entry there, and then aim for the near swing high, didn't quite get there, but hopefully you would have raised your stop loss up and got stopped out in profit. So there's that, and then after that I really don't see 2 minute anymore for the rest of the day. Okay, so let's go to the 1 minute. So 1 minute, I don't see the shift here. There's an interruption there. I'm just gonna look at the main swing points. Don't see the 1 minute there. There's the 5 minute fair value. That's what it looked like right here. All right, here barely occurs on the 1 minute. Right there. 1, 2, 3, 4, 5, 6. However, price never came back. Into this area, at least not right away. Do have one small one here, but there's no fair value gap anywhere around here, so you really should not be taking an entry there. All right, so we took out relative equal lows. If I saw this and we took out relative equal lows, I would be looking for longs at that point in time. I do see that we have 1, 2, 3, 4. Wave 3 does meet the criteria in terms of the shift, but no fair value gap and no inverse. So you should not be, let me blow this up. So yes, we took out relative equal high lows. We do have a little V formation here, but no fair value gap, no inverse fair value gap. So even though you see this, you should not be going long anywhere inside of here. And look, over here, just violated the whole thing. So keep that in mind. If there's no inverse or regular fair value gap, you should not be going long anywhere inside of it. All right, so going back here. So as you can see, we have one here. However, didn't really take out, like this little high, didn't really take out any major liquidity here, obvious. So then it goes back down. Now here we have a qualifying short, would have been a quick little scalp here. But we do have, all right, so we got the 1, 2, 3, 4, 5 bullish candles, right? We took out one short-term liquidity and also this recent liquidity right here, this recent swing high. Displaced, second candle closes underneath. We have two fair value gaps, right? We got one there, and then we got this other small one up here. Price goes back, if you were to enter here, it would have went a little bit deeper. Price goes into the upper fair value gap and then displaces. Again, I mean, ideally you would want to hold for this swing low here, right? And it ultimately does work. But if you're going to try to hold longer than that, obviously it came back against you. But it does work. Right? Comes back into it. See that? There it is. So you have actually two in a row. So you have one right here, and then again. However, this one did not take liquidity. This one, see, it didn't take out the swing high. But I do like to see this as a confirmation to keep holding to go lower. So there you go. 50% takes out the swing low. Obviously try to hold for that one if possible, but it doesn't quite get there. But if this was moving down here, man, I would have just squeezed the trade to like right here, so it ultimately been stopped out. You know, if I was trying to hold for that swing low. All right. So 1 minute here. So here's one. However, we didn't take out liquidity, right? So this one did not take out the swing high. So even though it formed here and price came back into it, you don't want to go short anywhere in here because it didn't take out any form of liquidity. And then it tanks, and then we go down into this fair value gap, or 1 hour fair value gap. So here's where I really want to kind of talk about on the 1 minute. So here you see that we created a BigO model to the downside, 1, 2, 3, 1, 2, 3, and then we have the fair value gap, and we also have an inverse fair value gap. Okay, the inverse is right here. I'm not going to draw it out, but right here. And so, as I said, like before, you know, if it violates it, so here it's, you know, it's holding, but it, you know, it's taking too long. Look at this. I mean, once it reached 50%, you shouldn't have more than like a couple of 1 minute candles, you know, no more than like a 5 minute candle. But here you see, you know, well, once it goes inside, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, almost 10 minutes. 11, 12, 13, 14, 15, 16, 17 minutes before it finally took you out if you were trying to go short using this. But the thing is, like, you really don't want to go short here because where are you again from where we came from? So we were way up here, right? Why would you want to go short way down here, which is also like, let me see send it for the 1 hour real quick. So right here, why would you want to go short when you're already down here? This is where we were. Like, you know, that swing low is like really close. So why would you want to go short there? That wouldn't make sense. That's what I'm talking about. Like relative to where you were, you need to figure out where you are. You know, where are you coming from premium? Are you coming from discount? And that's when you want to be looking for longs or shorts. So once we got down here, then I'm looking for longs, not necessarily shorts, because you know this morning we were way up here. I don't want to short down here. And so the formation does occur, but again, you just got to keep in mind where you're at. And so once we closed above it, once a body, this candle right here, closed above this swing high, then we start looking for an entry to go long inside this fair value gap, anywhere inside of it. And so, or the inverse, right? Either the inverse or the regular fair value gap. So it didn't quite reach 50%, but it definitely reached this inverse fair value gap. So you're just going to have to find a happy medium between these two as a conservative entry. I mean, ideally, I like to do 50% down here, but as you can see, it never reached it. So it's up to you on where you want to, what your risk tolerance is with respect to entering and you know, marking out your stop loss. So once that occurred, I mean, it just never came back. And also, you want to annotate the very first presented fair value gap that occurs every single morning because that's a model in itself. So if you miss the entry on the inverse down here, the first present to fair value gap after at 9:31 and after, you got to look for the obvious most first fair value gap that occurs. And here at 9:40 was the very first one. 9:30 opening was right here. And if you look through this whole um, price action, there's no fair value gap until right there. Price moves away, price comes back in, you go long anywhere inside this fair value gap. Knowing that we had a big O model, an inverse big O model playing out, pushes up, fair value gap presents itself, go long. And then when you go long, what are you targeting? The nearest swing high. And sure enough, right there, took it out. So within 1, 2, 3, 4, 5, 6, 7, 8 minutes, I mean, if you would have got it right at the end, in the beginning of the first fair value gap to there, that would have yielded 102 handles in 8 minutes. That's pretty good. That's beautiful. Yep. So anyway, on the 1 minute, that was the only. I mean, we saw it here in Asia, right? A couple times it occurred, and I had to tell you those for you. Now let's keep going throughout the day and see if it occurred again. And I don't think it did. I don't I don't think I saw it ever occur again. So it almost occurred here, not quite, fell short. Here almost fell short, so you couldn't use that. Here nothing, nothing. All right, so here's one. So we saw, so I noticed that we are coming from a premium. It did occur here. There's a fair value gap right there. But ultimately, this ended up blowing right through. And I think I actually took this short here. And yeah, I did. I took a loss. And that's okay. So once it violates it, then this turns into a inverse, right? So we closed above. So I initially went short, right? And now I would use that same fair value gap to go long. It does go just a little bit deeper than I would have liked, but ultimately pushed up, took out this swing high, this swing high. Obviously, I would have been aiming for here, but would have fell short, and ultimately comes back. And if you didn't move your stop loss, would have took you out. Perfect. All right. So then after that, I do see a bear. There's one here, but again, look, no fair value gap. There's no inverse or regular, so you can't, does not meet the criteria, and we never even took out any liquidity. All right, this would have had to take that out. All right, so keep looking here. So there's one, but no fair value gap. There's one there, no fair value gap or inverse. So this would have, if he would have just taken this based on the formation, man, he would have got chopped up. Again, I don't see on the one, nothing. One here almost, but not quite. Does leave fair value gap behind. Again, if it closes level with this one, for me, I would not count it as a shift in market structure. So here you could see the opening is the same as that candle. So I wouldn't have counted this. I did see it and I wanted to go long, but because it didn't close above, then I just sat on my hands. All right. So, and then after that, it just never came back. Do you see one here to go short? However, this did not take out the liquidity there, so that would not have been a good candidate to go short. And also, there's no fair value gap behind. There is an inverse, but you would have got stopped out right there. So at least that would have been a small loss, right? Again, we're already in premium, so we're not looking for longs at this point. So if you were to go short, you would want to go short somewhere around here. But here, do you have one here, I think? Nope. You see one here. Does close a little bit below fair value gap. It goes a little bit deep against you, but ultimately does go lower. So hopefully you would have took your stop loss and broke even at least. Comes back against you. And then basically just drops off. Here would be the final shifted structure right there. At 4:30, and then basically just close the day. Here's one here, but again, this did not take out that swing high, so it would not make a good candidate, even though it does have fair value gap, does close underneath. But you really want this to take out an obvious swing high or recent high. And so now here's the new opening. So we have multiple consecutive, and then down we closed. Yep, we closed a little bit underneath here. It's funny though, right? Because opening gap, new opening day gap right here, come right back into it. This would, I guess, in theory, right? This would be continuous, even though there's not a candle here. You would treat this as a continuation of a bearish candle. We took out this swing high, right? So we got 1, 2, 3, 4, 5, 6, 7, 8. And then we have 1, 2, 3. I know there's a gap, but you count it as a continuation. The close right there on the fourth candle. But while this was forming up, what do we take? We took out that swing high. Price opens up, close underneath there, retraces back into this gap or fair value gap, right? Go short. Go short there. Aim for the near swing low. If you just want to get a nice little quick scalp. It's about 40 handles. It's not too bad, right? So from there to, when did it hit? Right there. So about 40 minutes, 41 and a half handles would have been your profit. But if you're willing to hold longer, obviously you could see it just keeps going down. And now we're right here. One last thing. So let's go back to this little area this morning. I really want to take you on the 5-second because, man, this model, when you are in certain areas, especially like when you're have taken out a recent high or low, or you're inside a high time frame fair value gap like this hourly one, man, it's just you can catch damn near the bottom with this model. So this right here is the fair value gap on the 1 minute. So I'm going to go ahead and delete that. So here we are, the 1 hour fair value gap, and this is the 5-second. Okay. So we're looking for longs at this point because we're deep in discount, right? So once we've entered it, I'm looking for that same formation to the upside. And as you can see, it does not present itself anywhere, 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 not here. It doesn't present itself until right here, which is kind of near the bottom of the 1 hour fair value gap. So here's the thing about dojis. This one, it's up to you to determine whether you want to consider that a bearish or bullish. It's up to you. I like to take the risk because my stop loss would be down here anyway. So ideally, you would want it to be obvious, but this doji can be either bullish or bearish. So in this case, we do have 1, 2, 3. I would consider it a bearish just because we're also real deep in discount. And then we see an immediate displacement up, right? So at this point, once we see that, we have a market structure shift on the 5-second, okay? So this model, like, it's not just limited to, you know, the higher time frames, but these lower time frames are also very telling, especially when you're in key areas where price could potentially reverse. So here we go. We took out this swing low over here, right? We have the 3 candles, got displacement up, close above, and we do leave behind one fair value gap. However, this is a 5-second one. However, you want to enter on the portion. Remember, you want to enter on the portion where these 3 down close candles make up that part of the fair value gap. So anywhere from this opening price to down here is ideally where you want to enter. But because we're on the 5-second, like, the best place to enter is right at the opening. That's the most conservative one. So it comes in, pushes out. So we just took out this swing low. 1, 2, 3, 1 up, close above, and this is obvious displacement, right? One giant candle. Fair value gap left behind. Price comes back into it right at the opening price, goes a little bit past, pushes off. Okay. Price comes back down one more time, right here. Okay. And didn't quite take out this swing low here, but what I did like was that it made a continuation of the big model, of the big O. So here, another 5-second. There's the market structure shift, right? We have 1, 2, 3, 4, 5. We didn't quite take out that swing low, but we took out multiple lows here, and that's good. This opening price still held, pushed away. Another shift in market structure, another confirmation, right? What does it leave behind? Got another fair value gap, right? Price pushes off, comes right back into it. Consequent encroachment of the fair value gap. You can add another one there. And then what happens again? So this little spike here took out this little intermediate swing low. We have another continuation on the 5-second. Nope. This one doesn't quite leave. I mean, it leaves a very fair value gap right here. But the more obvious one is the inverse. There you go. Inverse 5-second fair value gap. That. So again, if you saw this, if you didn't catch any of these, you saw this one, The most conservative entry, or at least so you won't miss the move, right, is right at the opening price. As soon as price touches it, or if you want to be extra conservative, then wait for the inverse fair value gap or this little tiny fair value gap right there. But if you would have tried to use this one, it never reached it because it didn't even reach 50% of the inverse. Stop loss right there. So from entry, that's what? 7.5 points. Big deal. It's not going to kill you, even if it would have came down. But look how beautiful, just so beautiful, man. This right here, it started taking out that swing low. We're at the lower portion of the hourly fair value gap, and then this beautiful stuff occurs. Multiple confirmations. Look at that. And if you would have held, I mean, obviously, you would have made a huge, huge win. So there's that. If you would have held for somewhere down here to up here, and that's 38 handles. If you would try to hold up here, 80, 79, and then this little fair value gap right there, 81 and a half handles roughly, 86.75. But that's really what I wanted to show you. When you're in very key areas where price is likely to turn, if you can go down to the 5-second, 15-second, 30-second, and look for these things, and you'll be amazed about how fast this stuff can work for you. It's beautiful. Anyway, it went a little longer than I anticipated, but I really wanted to go down, the time frames, and that way you can kind of see it, right? And hopefully that helps. And I believe that's all I got for you today. Until next time.